Good morning. My name is James Kim, Chairman and CEO of AMCHAM Korea. Thank you so much for joining today's webinar, and it's a topic called Top 10 Financial Planning Issues for Global Families, and basically many of us on this call today. I think that today's topic is really important, and we should take this obviously very seriously, especially given the constant change in tax considerations, including estate planning. And I think for many of us here on the call, there are interesting combinations. US citizens living in Korea and married to a Korean national, and I'm in that camp. US citizens living in Korea, married to another US citizen or another foreign person. Korean citizens living in Korea with children who may be US citizens living either in Korea or living in the US, and obviously other foreigners in the situation I described above. You know, today, I'm very happy that we have Stephen Giacona. He is the CEO and managing partner, and Fred Behrens, he's a director of wealth advisor of the Roundtable Wealth Management Company based in New York City. These two gentlemen have a lot of insights and could be really, really valuable. With over 30 years of experience in advising individuals and families on what we call complex tax and investment matters, Stephen's role ranges from managing client relationships to overseeing the firm's investment. Stephen's area of expertise also include non-traditional investors, attorneys, business owners, CEOs, and obviously international families. And Fred is well respected for working with very high net worth individuals and international families. In particular, I think Fred has significant experience working with US citizens living abroad, not just in Korea, but in other parts of the world. So in today's webinar, Roundtable Wealth Management will guide us through the unique investment management and financial planning issues that American citizens and foreigners living in Korea face. And we're gonna have a lot of discussions on this topic today. So I hope that the presentation will be beneficial to all of you, especially those expats and people who need to properly plan their personal situation. So what I'd like you to do is, if you have any questions on the Q&A function, please type your question and we will address it properly. This program will also be available via YouTube when we're done. So if you want to review what was discussed, it's another opportunity. So without further ado, let me hand the mic over to Stephen, and he will walk us through. And believe me, even I'm going to be very intent on listening to this webinar today. Thank you. Stephen, it's all yours.
Thank you, James, and thank you for the opportunity to be a new member of AMCHAM and to present to your members on a very complex and important topic. We recognize that there is a diverse knowledge base regarding tax and investment planning within this audience. Our objective tonight is to touch on a few of the more salient issues and how they may be addressed effectively. The presentation is really not intended to be a recommendation or an exhaustive discussion of the US-Korean tax treaty. That being said, our agenda tonight is quite comprehensive. My colleague, Frederic Behrens, who you hear from in a moment, will dig a little deeper into these 10 topics, which are going to include, financial account reporting, domicile versus residency, currency management, Korean estate inheritance tax rules, pre-immigration, just to name a few. Fred, if you can flip the page. Before we jump in, I got obviously the marketing couple of slides. I just want to touch on Roundtable and introduce ourselves. You heard, and James, thank you for those introductions. Fred actually leads the global family practice at Roundtable Wealth Management. He's an expert in cross-border. I grew up and cut my teeth on cross-border U.S. expats and foreign nationals at one of what was then the Big 8 accounting firms, and founded Roundtable in 1999 at the behest of a number of families who asked for objective financial advice and a trusted advisor who can go out in the marketplace on their behalf. We have 4 offices within the United States. We maintain a fiduciary standard and relationship with all our clients, which means that we put our clients first before any decision making is made. Recently, we're now members of AMCHAM and we've had experience with many cross-border families, including Korean American clients. Fred and I travel extensively, and we offer in-country seminars. Here we are, we did a joint seminar for Chicago booth in London a couple of years back, and we thought we would just share that with the audience. And 30 more seconds before we jump into the topics at hand. Roundtable Wealth Management is a little bit different than many of the other firms, clearly the broker-dealers that are out there. We operate on a very holistic basis in advising our families. We look at everything that touches their balance sheet and or income tax return and try to integrate the two together to optimize efficiency, because we recognize it's not what you make, it's what you keep. All right, and whether it be on an investment return or wages or some deferred compensation, we try to keep the tax man out of our clients' pockets. Our clients look to us as their primary point of contact often, meaning the first phone call if it's a matter on investments, tax, or often life-changing decisions that they're coming across. So we fill a niche for many of our families, and I call them our families because that's the type of relationship that we build. It's much more long-term than it is transactional. So we're going to cover a lot today. I hope you have a lot of questions, and to the extent that we can't cover them today, our contact information will be made available after the webinar. And with that, I'd like to turn it over to Fred, who's going to jump into our top 10. And Fred, where do you want to start?
Stephen, thank you very much for that introduction. And as you mentioned, we have a lot of topics to cover today. So if we pass through something a little too quick or more relevant to you, I can't stress enough, please feel free to type out these questions. Plan to give us a call or shoot us an email afterwards. We're happy to have a call with you to understand your unique circumstances. And we look forward to having a really informative discussion. So why we are all here today, the global family financial planning dilemma. So I think everyone's kind of familiar with this, particularly living abroad. Many U.S. citizens around the world are subject to U.S. income tax and estate tax on their worldwide income. And, due to this factor, what we're going to talk about here is that there's a complex interaction of the U.S. rules and the Korean rules, how they really apply to investments and earning income and retirement savings. And I think probably the most important line in this whole webinar is you have to really remember, financial strategies that you may have used in the United States may be counterproductive for American citizens in Korea. That's the only line from the webinar I'm going to read outright, because I think it's just really important. You really have to coordinate all investment and financial planning, not only with the IRS, but the Korean National Tax Service. And I can't stress that enough. And I think this sets the stage for really all the nuances that we're going to cover. So one of the first issues is kind of on the U.S. side. So the U.S. passed the law, the Foreign Account Tax Compliance Act, FATCA, and this really increased, difficulty in reporting and having foreign bank accounts, whether it's in Korea or Hong Kong, Singapore, Europe. Many other, banks closed accounts of U.S. citizens due to really strenuous compliance obligations and other, reporting hassles. they said it's just easier to not work with Americans, and that led to kind of a great exodus of U.S. clients. Going forward now, so a lot of U.S. citizens lost local banking access, is that there's more and more restrictions at U.S. financial institutions. We hear this all the time. More recently, for example, Wells Fargo restricted accounts of clients living abroad, Merrill Lynch, UBS, Morgan Stanley, Goldman Sachs. Many of these large financial institutions are finding it easier to restrict kind of non-US based clients than to develop the client, the reporting and the regimes around that. But the good news is, at Roundtable, we do work with custodians that do work very well internationally. So it's not impossible to have a U.S. account, whether it's for an IRA or a 401k rollover or Roth IRA or 529 while living in Korea. There certainly are ways to maintain these accounts in a compliant manner, and we receive many inquiries based on that. Beyond kind of understanding where to just have an account, going back to the interaction of the two tax systems. It's the U.S. is easy, right? If you're a U.S. citizen or a green card holder long term or live in the U.S., you're always paying tax, right? So it's pretty easy to know if you're a U.S. taxpayer. If you have a blue U.S. passport, you better be telling the IRS about everything all the time, or we should talk because you might have a big disclosure problem. In Korea, it's a little bit different. For a foreign worker, particularly. There's some very unique laws about, when you come to Korea, there's a possibility to pay a flat tax, which is kind of changing at the end of the year. And kind of more important, you may be able to exclude certain Korean source investment income, so that could be U.S. assets, from Korean taxation for up to 5 out of 10 years. And, so understanding kind of when you're in Korea, how long you're staying in Korea, throughout this webinar will really have a dramatic impact on what you should do. And we always like to say, long-term residency and, becoming fully domiciled, kind of, if you came to Korea and you never leave, requires the most planning. So we always kind of caution individuals to, always think ahead. You never really know how long you're going to stay in a country. And, some people think they're coming on an expat assignment for 3 or 4 years. And, 20 years later, they're still there and never leaving. So we think, always plan ahead, because we're going to talk a little bit about some nuances with investments and such around these rules. So how do we kind of work on understanding the always being U.S. taxable, maybe different types of Korean taxation on the financial plan? And the first thing that we want to start with is kind of on the U.S. side. One of the most common mistakes by U.S. citizens living abroad, no matter if you're in Korea, Japan, the UK, Australia, really wherever in the world, is owning non-US investment funds. So being in a non-US country, we realize that you may see local banks or other investment companies, having fund products out there, and you might just be, I'm earning in Korean won, or I want to keep an account in Singapore, or I have a family member in India, why not invest there? Well, the U.S. classifies these as passive foreign investment companies, or PFICs. And this term is going to come up quite a few times in our seminar today. So a PFIC is really any non-US listed mutual fund, ETF, hedge fund, private equity fund, really anything that's not, in dollars or really regulated by the SEC and traded in the US. And the reason you don't want to own these is the IRS, they basically don't trust these. They say, well, there could be a lot of, funny business going on under the fund. You could be deferring gains for a long time. So we are going to tax you at the highest rate. We are going to have a very complicated annual reporting requirement, and we won't let you defer gains. So each year you have to pay tax on the increase of your investment value. So these funds we really think are important to avoid and understand if you own them, that they may be quite complicated to report. So our view is for US citizens, and not just US citizens, which we'll get into, is owning US listed ETFs, or exchange traded funds. These are very efficient to own at US financial institutions while living abroad. Many US financial institutions and mutual funds will restrict distributions of mutual funds to non-US residents. And this law has been around for decades. And with an ETF, you could really access a very wide range of global investments at a very low cost. So we prefer ETFs or exchange traded funds as one of the best vehicles for building an investment portfolio. And I mentioned one of the lowest costs. So I think, not just for US compliance purposes, but we think for many non-US investors, because we realize we have quite a mix of individuals on this call, that using US financial products are very efficient. If you see here, the US has one of the largest financial markets in the world, down the street from me at Wall Street. We're up in Midtown in New York with the Christmas tree at Rockefeller Plaza, but you could really buy and trade any security or buy, Korean companies, Japanese companies, Indian companies with great liquidity and low cost. So we point out that we think that, compared to many other countries in the world, the US is a great place to access global investments. So we work with many non-US citizen clients that want to have the efficiencies of owning US investment funds as well. But again, going back to this, it's, not every investor is the same. So we, again, realizing that there's maybe some non-US investors on this call, or mixed nationality families where one spouse is a US citizen, the other is not. It's important how you own assets, right? So we do think, again, building wealth through a US financial institution is very optimal. We talk about these PFICs and avoiding some of these different investments, but US taxpayer must also they could own these assets directly. And kind of one nuance we see working with clients in Korea is that you really got to think through some of these tax rules, right? So if you're in Korea, on your first 5 years and you're excluding non-Korean sourced income, you might want to own US municipal bonds. You pay no federal income tax on the income generated from these, but you take a lower yield. And the moment that you become a full Korean tax resident, you will start paying on some of this interest coming from the US. So you basically have taken a lower yield, a lower investment return, and are getting taxed. And it's just kind of one nuance. So thinking maybe what you were doing back in New York or California, it might not make sense to own these investments anymore. So you really have to think through kind of the taxation of individual investments and what's efficient to own. For a non-resident alien, there's a couple of reasons that you may want to own non-US investment products, actually, right? Or set up an offshore blocker corporation or a trust structure. The US does not have an estate tax treaty with Korea, and there could be some very high tax rates on owning US assets by a 100% Korean citizen living in Korea. And we're going to talk quite a bit more about that later. But I like to point this out here that we are familiar with setting up some more complicated structures for non-US citizens to own US financial assets in a tax effective. Beyond just having a financial account or having the right investment product, you really have to think through, as a global investor, where are you spending your money? I think, because as Stephen mentioned at the beginning, we all want to invest for a specific purpose. We want to make our money work for what's important for us, and whether that's retirement, house purchase, college expenses, other goals. And when you're between multiple countries and currencies, you have to plan for that. So the Korean won and the US dollar are fairly closely pegged, and there's a long history. It's not as dramatic as some other currencies. I think the Turkish lira is in the news now, losing 40% of its value this year, or the British pound after Brexit. Everything dropped in value. But we always want to say you want to match your current assets, such as your investments account, your savings, especially when you're earning in another country, to your future liabilities. So we always want to take a view that you want to own, maybe if you're planning to live in Korea long term, or you want to retire in Australia, you want to build a portfolio that has more exposure to non-US assets or country-specific assets. And this will protect your spending power if the dollar were to decline significantly in value. Right now it's great. The US dollar is very strong against a wide basket of global currencies, but that can always change. And you don't want to be overly reliant on any particular currency or the wrong currency to fund your future expenses. So we look through that very closely with clients, help transfer funds effectively between countries. There's some nuances with Korea and other Asian countries where the currencies are more restricted. we're very familiar helping clients navigate some of these hurdles and to build a successful portfolio. So some common questions we get more from the US citizens or the US expats are related to retirement accounts, college savings, Social Security. And there is a double tax treaty between Korea that provides a very limited protection of retirement accounts, for example. But you have to be a little bit careful. If you're going to have a 401k or an IRA or a Roth IRA, you need to be careful. Korea may tax some of these investments with withdrawals differently than you are planning on. One thing that really jumps out, what we see, given if you've been in Korea for a while, again, if you're here on your first 5 years, you may there may be some opportunity to make an IRA contribution. But generally, if you've been in Korea for a very long time, the tax rates are higher than U.S. tax rates, and you're not really achieving any benefit by putting money into an IRA, for example. And so we see a lot of people that they get in the habit of doing this every year. Maybe they're in another country that has low tax rates. You're transferred from Hong Kong to Seoul. In Hong Kong, it's a very low income tax, and you always made IRAs or 401k contributions. That might not be the same in Korea anymore. College savings accounts, again, 529s, very common to build up large reserves and these to pay for college. And these are special accounts in the U.S. They generally grow tax-free. There's some other benefits, maybe in different states. But if you're really in Korea for a very long time, these are foreign assets that must be reported. Korean tax law gives these accounts no special tax treatment. So you really have to pay attention to how you're going to report these in the future. Work with an accountant in Korea on understanding what you need to do with these accounts, because it might not make sense to overfund these or keep them even. And lastly, another common kind of question we get that many people don't know about, this is more for mixed nationality families, which we'll talk about, is that American citizens that have significant or any Social Security work history, their non-U.S. spouse may actually receive a benefit based upon the U.S. spouse's work history. So if you're a U.S. citizen and your spouse is only Korean, they may actually be entitled to receive about half your benefit as a spouse. So many people don't realize this. You could go, you could backfile the Social Security, but if you know this rule, it's a great extra income in retirement when you're of that age. So there's a lot of these nuances to understand when one spouse is a U.S. citizen and one is not. And that kind of leads me to my next section on some more kind of advanced planning when you have a U.S. citizen spouse, and whether it's a Korean national spouse or you're married to a British person or someone that's not U.S. taxable, there can be some opportunities for planning. So most of the time, it's generally advantageous to keep the non-U.S. spouse outside of the U.S. tax system. Most people may do married filing separately. If you have dependent children, you could do head of household. But again, you keep the non-U.S. spouse out of the tax system, primarily so you don't have to report all their assets to the IRS. This would include any investment accounts they own, real estate, sales, their employment income. And many people, I think this is the easiest way to keep it kind of clean between a U.S. taxpayer and a non-U.S. taxpayer. There can be an election to file jointly, but you can only revoke it one time. There may be some advantages given where you're living in the world that this makes sense. Generally you have to think it through. It may make sense possibly if one spouse has a very large income and the other doesn't. Generally, again, not in Korea due to the higher income tax rates, but if you're planning a relocation, maybe to Hong Kong, for example, or another country with a different tax regime, it's something to consider. But you must think long term, because you can't flip-flop back and forth every year. And here I want to talk through kind of an interesting property ownership strategy when you have a non-U.S. spouse. The Korean tax code has a very generous capital gain exemption for home ownership of a primary residence. There's quite a few nuances, given how long you live there and some other things, but it's generally a little bit higher than the U.S. exemption. The U.S. exemption, you can exclude $250,000 if you're filing single or a little bit more jointly. But if you're in Korea long term and you have a non-U.S. spouse, it may be beneficial for them possibly to own the residence or out of your name to possibly take advantage of allowance that's a little bit greater than US law, right? So if you're not filing jointly, you can use the Korean exemption that's larger to save on some capital gains. So I thought that was kind of an interesting planning opportunity to bring up. There can be lots of other planning opportunities between, transferring assets between spouses. For example, if you're living in Hong Kong, which has does not tax capital gains outside the country, you could transfer, the Tesla stock you bought 5 years ago and have your non-US spouse sell it without incurring capital gains. It's a little harder again in Korea, just due to the higher tax rates and other gifting rules, which we're going to talk about. But some other countries, I just want to point out there because I realize we have a very kind of mobile crowd on this webinar, that you can, a U.S. person can give to a non-U.S. spouse up to $164,000 a year without reporting that. But in Korea, there are some other gift tax exemptions that negate this, right? So very important to pay attention to how you're titling accounts and property, and really understand what the U.S. person owns, what the non-U.S. person owns. And then the non-U.S. person, we talk about these PFIC funds, the non-U.S. funds, they could own everything they want. They're not restricted by owning these special PFICs, which create a huge problem for U.S. citizens. They can go buy all the private equity funds or mutual funds outside the U.S. they want and not have any U.S. problems if they're not filing jointly. So we talked a little bit about income tax, which is very important and many nuances. But now let's move on to kind of more cross-border estate planning, because I know that's a very common question that comes up. And I like to start with this slide. I think the U.S. is very unique that we have a very large exemption amount for an individual, so almost $12 million. If you're both you and your spouse are a U.S. citizen, it's over $24 million that so many people in the United States do not pay estate tax at all. It gets a little different, if you're a green card holder, it's focused on domicile, and there's some you could transfer between spouses unlimited and such. But it gets a little bit more different now if you're a non-resident alien, right? So if you're not a U.S. citizen, you may actually owe some U.S. tax on certain U.S. assets. There's a very low exemption amount of $60,000 on owning U.S. assets. So we can get into that, and we talk about this blocker structure that could avoid it a little bit. But I think understanding if you're not a U.S. citizen and you own certain U.S. assets, they're called, there's very little, very little exemption, and you're facing a 40% tax. So in this example, for example, if you are only a Korean citizen, you own a house in New Jersey, for example, you have a U.S. brokerage account that owns many U.S. stocks, maybe you own Apple, Tesla, some of these other big names that have gone up a lot in value, and you pass away owning this, you could be facing on this, in this example, you have about $12 million. You're only having a $60,000 exemption. The rest is taxed at 40%. Then you may additionally face some Korean tax, which we'll talk about, but generally Korea may credit some of the U.S. taxes paid. But very important to understand, if you own U.S. assets and are not a U.S. citizen, to understand which structures, such as a trust or a corporation, may be put in place to avoid the imposition of these taxes on U.S. assets. So moving on to Korea more specifically, Korea has one of the highest inheritance taxes in the world, with rates up to 50% and very low exemption amounts. It was in the news worldwide, when the Samsung heirs inherited, and there was billions of dollars being paid to the Korean government on assets that were inherited. So Korean, there's a lot of planning to be done, possibly around paying these very high tax amounts, which is quite different than the U.S. So it's really based upon where the contrast to the U.S. as well. It's based upon the person receiving the assets or a gift, right? No matter where the asset really is, it's all about where what we call the donee, the person receiving it, is based. So if you're based in Korea and receiving an asset, maybe in the U.S. possibly, or in Korea, it gets a bit more nuanced as well. There could be quite a bit of tax owed on that transfer. There are, different, Korea does provide, foreign tax credits if you're paying in the US. It's not treaty based, as you mentioned. So this could alleviate a lot of taxes paid. And I enjoyed a prior AMCHAM webinar put on by the law firm Kim and Chang, which talked quite a bit about this in very good detail. And one of the lawyers at the firm said, don't die in Korea, right? So break your domicile, break your residency, because there's, in the US, there's a lot of planning you can do of trust and other things, but it's quite a bit different in Korea and much more limiting. So I would encourage everyone to review that webinar. It was done a little bit more than a year ago, and they go into quite a bit of detail on both countries' systems. We also hear, a question maybe for family members back in the US, right? So whether it's you have a child that's back in the US and your grandparents are in Korea, or you're in Korea, or maybe you're no longer a US citizen, there's no US tax on receiving an inheritance or gift. However, I really want to stress it's vital that this, even though there's no tax on it, that the inheritance is reported. There's an IRS form 3520, if the gift or inheritance is over $100,000. An incredible amount of reporting that needs to be done. And there's really large fines if this is not done correctly. And we hear really, really sad stories where, individual inherits a property or land, and they don't think to file this form, and the IRS comes several years later and is aggressively pursuing penalties that can go up to 50% of the asset value. So foreign assets, again, if you're a US citizen or domicile, you receive a step up in cost basis, even on foreign property. So this could be a tremendous advantage, for individuals leaving appreciated assets or real estate to a US person. But again, remember that if you're in Korea, possibly, right, you're still, you have to pay tax, right? Because it's based upon where you live, the person receiving the asset. So again, be very mindful of kind of where your assets are moving and where they're going. And if you are inheriting foreign assets, remember I always talk about these foreign investments, the PFICs, right? And remember about all the US kind of informational reporting requirements, which we cover in one of our last slides. So be very cautious inheriting from abroad, and understand that you may have lots of forms to fill out. And, we get a lot of questions from individuals that are maybe kind of newer to Korea, or foreign workers in Korea. The US and Korean probate law is fairly similar. There's some nuances on kind of who receives assets, and, more a little bit forced in Korea, who you can distribute assets to. But it is possible if you're more of a temporary person in Korea, that, you have a US will, maybe you're on a more temporary assignment, you can probably keep your US will for some time. But even going back to my first slide, the longer you are going to remain in a foreign country, it's much more important to kind of have a will and testament that conforms to their local laws. I encourage individuals, that it's fine if you come to a new country and have your old will from New Jersey or Texas for a few years, but the longer and more ingrained you are in the local system, certainly after that 5-year mark, I think you want to revisit your estate plan for the law of the country you're domiciled in. And we always like to point out that, it's really important not to just, make a bunch of wills, right? So if you have a will in the United States or someplace else, then you might want to revoke it, right? It's a last will and testament, and it's generally effective to have one will that covers most of your worldwide assets, with certain exceptions for property, for example, and other things. But really not to have any confusion over your last wishes by having several wills that are, you think you have a US will for something, or you have a Korean will for something else, or you're relying upon Korean law for something. So we want to, the longer you're in a foreign country, please revisit your estate plan. And kind of the last estate planning topic is, many individuals in the United States are very familiar with trust. Trust, whether they're funded or for estate tax purposes or more for probate avoidance. It's important to understand that, Korean law, trusts are a newer concept. And, there could be some uses, before you're domiciled in Korea, or if you're moving from Korea or another country. But I think this warning is that, trusts do not travel well across borders. So US trust law, very different than trust laws of other jurisdictions. So be very cautious if you're asked to be a trustee of any U.S. trust or foreign trust. Be very cautious if you are, relying upon a revocable trust in the United States, or maybe a life insurance trust. These could have potential, serious tax ramifications or other ramifications about not getting assets where you want them to go, because maybe, it contradicts kind of a norm in Korean law, or it wasn't set up properly. So again, if there's substantial trust in your estate plan, maybe in the United States, and that's kind of what you've been relying upon, I think really vital to speak to an expert sooner than later to sort that out and understand that there's nothing hidden that may create problems down the road. And, kind of wrapping up the one or two last topics is we want to touch upon insurance, right? So roundtable, we don't sell insurance, but we're certainly very familiar with global insurance strategies. So many individuals come to us with questions about life insurance, and there's lots of reasons for it, whether it's estate planning, business planning. We often see many non-US citizens really consider US life insurance as a very sound investment. It's a great way to get exposure to, the US dollar, US kind of growth. And there can be many benefits to having a policy set up on passing assets to certain individuals you want to. So we like to bring this up, and it's just, it's also a great way to diversify possibly your portfolio. So kind of don't overlook possibly US life insurance living in Korea long term, but also don't ignore several other insurance topics. For example, health insurance. So we know many companies that send assignments, individuals on assignment in Korea keep, global health insurance policies or US policies that provide coverage, all around the world. And, a couple things we like to point out, the Affordable Care Act, or Obamacare, makes it much easier for many individuals that maybe are returning to the United States for, an earlier retirement, or a change of jobs, or they want to start a business. You could come back now to the United States and very easily obtain health insurance coverage with pre-existing conditions. It's not always going to be cheap. It's quite expensive, especially once you're in your 60s, kind of a little bit before Medicare. But you can get it, and that's a lot of things people don't realize when planning a move back to the United States. And one other thing we say, retiring. If you're retiring, or your parents are retiring in Korea, but there's always a chance that they may come back to the United States. It may make a lot of sense to elect Medicare at 65 and start paying premiums on Part B sooner than later, because these premiums will go up every year the longer you wait. So if you think there's a good chance you might end back up in the United States when you're 75, maybe to be closer to family, or it may make sense to start electing Medicare sooner than later to lock in those lower rates rather than get hit with penalty. Disability insurance, another kind of often, discussed topic. It's usually covered by employers. You want to review your employer provided options. If there's a supplement, or maybe you move to Korea with, an outside policy, it's really important to understand when and where the benefits may be paid. Many of these policies only will pay out benefits in the United States. So if you're paying a supplemental policy and you were living in California, that's great. But if you move back to Korea, for example, and this is where your family is, and if you were injured or unable to work, you would be staying in Korea. You may want to discontinue one of these policies because you're not going to get any benefit. You're not going to want to move back to the U.S. to collect out on it. So we often see kind of long-term care insurance, which is a little similar to disability. This is kind of more related to nursing home, end-of-life care. It's quite popular in the United States. There's some options that exist that pay benefits globally. And with property and casualty, so mainly on houses and other, cars, boats and such, it's very possible to combine global coverages. So if you have several properties in the US, Korea, another country, working with a more nuanced broker, which we can make recommendations to, could give you considerable cost savings on insurance. And now, kind of getting to our last topic, I think kind of a fun one, and I think we're right on time to end with about 45 minutes, and we're starting to get some questions come in. So please start to send these through, and we look forward to having a little Q&A at the end on entering and leaving the U.S. Right. So I like to point this out. Being a U.S. citizen a U.S. taxpayer, there's lots of different kind of IRS reporting requirements, whether it's, owning a foreign business, having a trust, going back to these PFICs, right? So lots of different and complicated forms to stay on track of that may be, especially with foreign business ownership, they may be very punitive, right? And, so this has caused many people recently to really, consider, what do I do if I am moving to the United States, maybe for a job, or more so a non-U.S. citizen, or maybe you're having your son or daughter is going to school in the United States and will become a U.S. taxpayer. It's really important to review the global balance sheet before you move to the United States and become taxable, maybe get a green card or pursue citizenship, right? There's often things you can do before the move to ensure that your investments are properly held. They're not going to be punitively taxed, and there's not going to be, kind of issues lurking, right? So you want to review your investments if you're, particularly if you are a business owner, right? If you're a non-US citizen and own a business in Korea or elsewhere, you really want to review that before becoming a US tax person. Lots of the planning opportunities, again, will, like I say, evaporate once you have a green card or spend substantial time in the United States. So if your children are going to school at NYU, and they're beneficiaries or own shares in family real estate company, and they get a green card and they never leave the United States, it could get quite complicated, for every other family member that's never even been to the United States, right? The US tax law could extend into having different reporting requirements for the businesses and such. So we do a lot of work with planning for individuals moving to the United States and structuring their affairs properly. At the same time, we see a lot of people that they don't want to be U.S. taxable anymore, right? And we see individuals that want to, what I go through, expatriate. And it's not really just U.S. citizens doing this. I think it's more often many green card holders who have come to the U.S., had their careers here maybe, and are going back home. Maybe it's 10, 20, 25 years in the United States, and they want to go back home. There can be quite a big exit tax owed, right? So in this example, there's a U.S. citizen, Korean citizen that's living in Korea. They have U.S. assets, rental in New York, a brokerage. They have assets all over the world. They really want to consider the exit tax, which starts really above $2 million of assets before leaving, right? And I think many people decide actually not to expatriate or leave the United States due to this exit tax. And also, there's a rule that if you do give up and you're called, let's say, a covered expatriate, you will pay this exit tax, but then any assets passing to U.S. citizen children or other heirs will be taxed at a really high rate as well. So I think at the end of the day, many people do not give up their citizenship. Many people, if you're around the edges, do a lot of planning to try to get around some of these rules. But I think it's a popular topic, and I think for a green card holder, it can make a lot of sense. But again, a lot of planning needs to take place to do this properly and make sure that you're not at a worse situation than you were before. So that's kind of the end of our, I think, the 10 really kind of critical topics. And I know within the 10 there's a lot more nuances. And again, we're gonna have some good question and answers. But I want to maybe open it back up to Stephen and I to talk a little bit about why hiring a financial advisor and why Roundtable may make sense to work with you for your financial affairs.
Yeah, and Fred, great job. And I see some questions are coming in already. I mean, why an advisor and why a comprehensive advisor is critical. Everyone on this call is extremely busy, CEOs, leaders in their industry, and family members, I'm sure. So to focus on all and become expert on all the topics that Fred just went through, and then to be able to coordinate the tax professional, the insurance professional, the investment professional, and your attorney in the process becomes overwhelming. And what we see is there's leakage in the way of dollars. Oh, I spoke to my accountant about this, but I forgot to tell my attorney, or my insurance agent was going to handle something and I forgot to talk to someone else. And we see excess taxes being paid. We see costs. We see opportunities being missed. So we're big believers in centralized thought process and planning, similar to you all being CEOs of your respective companies, coming out and then building a management team around you. And Roundtable fills that role. And we believe that we have quite a bit of knowledge, as Fred represented, and and our history represents, to help you and to help all our clients through this process. And probably the most important thing is we know what we know and we know what we don't know. And I think that's critical in the process of being able to reach out to other professionals and coordinate the process on behalf of you, our clients.
And, we'd like to just show this slide a little bit, how we justify our value, right? Helping you, as Stephen mentioned, make smart decisions across your balance sheet. And there's several studies that have been published that, we help, not just the investment management is one part of it, right? Selecting the right investments, maintaining the portfolio, keeping investors from making their own behavioral mistakes, right? So understanding, we've had a lot of volatility in markets the past couple of days and weeks with the new COVID Omicron variant, but, keeping you in it and rebalancing appropriate, and really think that sometimes working with a detached, advisor can help make this happen. And then, a lot of the planning and the tax that Stephen mentioned about, it's not, not what you make, it's what you keep. And I really think in the cross-border area that, this is a US focused study that we could save you a lot more in this area, right? Just making sure you're doing the right things and understanding your Korean residency, your tax status, avoiding non-US investments. We certainly add a lot of value. And I'll leave it back to Stephen now to give the final pitch, I think, right, from the firm you founded about why us specifically, right, what he's grown us into.
Now, I want to thank everyone for allowing us the opportunity, and I do want to get to the Q&A. The key is for Roundtable Wealth Management, we're objective. I'm a CPA. Fred is, holds his JD. We put our clients first all the time. We're in the advisory world. We're not in the sales world, and that's very, very different. We're a boutique firm. We control everything in-house, meaning there is no public agenda. There are no earnings releases. We don't have to account to anyone other than our clients, which we do. And we're committed. It's not an up or out mentality. Our employees are here for the long term because our relationships with our clients are here for the long term. It's very much a multi-family office service model, which allows us to really embrace family on multiple generations. So again, I want to thank you all for participating and hearing, some of our guidance here and Fred's insights. And let's jump into some questions, James.
Stephen and Fred, thank you so much. I thought you guys covered a lot of the salient topics that a lot of us are very interested in. So as people are kind of thinking through their questions, let me just kick it off with a couple of questions that I have right now. One is, you talked about KYC, which is know your customer rule. I know that a couple of us have already received from our US banks the know your customer questionnaire, where if you don't answer some of these questions, they're going to actually block your accounts. Quite frankly, I'm one of those cases. It's all clear, but the kind of questions that a bank asks you could be really, really onerous. It gets very, very sensitive as well, because they want to know everything you own, your assets, your liabilities. So if you could talk about that, that would be great. And second is, there's a lot of misunderstanding about people, US citizens living in Korea. Can they actually own a brokerage account in the US or even a bank? Because there are some legal questions on whether it's even legal to own a brokerage account unless you have a residency in the United States. So those are my two questions, and then I guess we'll have more questions coming in.
More questions coming in. And, to comment specifically, so we, as Roundtable, we work with several different custodians, particularly Charles Schwab, Fidelity, JP Morgan, TD Ameritrade. Each custodian has their separate policies, but, in particular, we've worked with Fidelity with clients in Korea. We're able to, complete the, the proper KYC, the know your client rules. But I do want to say that, options exist. There's several other companies. It can be somewhat facts and circumstance to the individual client at hand. If they're a U.S. citizen or a Korean citizen, or if they're only a Korean citizen. But I want to stress that the way that we work on the institutional platform of some of these kind of big names, we are able to work with a wide range of U.S. account, brokerage accounts for U.S. citizens living abroad.
And I think, Fred, you can see the questions that are out there. So
Sure.
maybe you could run it for us.
Sure. Let me read some of these questions. Again, if we can't get to your question or we can't answer it completely, Stephen and I are very much happy to have an individual call to kind of understand, the unique issues that you're facing as a cross-border investor or family. So, I always want to remind everyone that we have our emails, our website. I think we're going to circulate the replay and such, that we're very happy to have that personal call. And one of the first questions is, for U.S. only expat families living in Korea, what are the most consequential changes that occur when you exceed 5 years of living in Korea? Right. So I think there's really two things that we've seen common. Is one, that there's this initial flat tax for foreign workers, which has gone through some refinement recently. It used to be 19%. There's some changes that have increased it a little bit, right? It's a little uncertain how you need to continue that. But that would essentially mean you may be subject to much higher, Korean tax rates on your employment income, right? So on the 19% flat rate, if you're a fairly high earner, maybe $300,000 or $400,000 US dollars a year, you're paying, you're still, you're going to the US and saying, well, I paid 19% in Korea, and crediting some of those foreign tax credits to your US your US tax return, right? When you're off that flat rate, you're still crediting everything to the US, but you're paying much higher, up to 45% rates in Korea. So that's kind of one thing. And it also implicates, again, that 5 out of 10 year rule, where then all your worldwide income is taxable, right? So that may change the investment strategy. That's going to create a lot more burden on the individual taxpayer to properly report assets in both countries. So I think those are the two big things that stick out and need planning for. And here we go. As a non-US spouse of a US citizen in Korea, do I need to worry about my US stock investments, mostly through ETFs, and cryptocurrency investments being taxed by the IRS as my spouse's income? Again, this will come down to, I think, really keeping it separate, right? So if you want to be certain that you're not filing a joint tax return, or or kind of separate that, or make the election to kind of put up that wall. But no, I mean, if you're the IRS really has no business of a non-US citizen, even if married to a US citizen. Here's one. We talk a little bit about the US citizen spouse giving to the non-US citizen spouse, and there's those annual gifting limits of $164,000 next year. So the IRS really cares about money kind of flowing out of the US tax system, but receiving, if you were to give assets to your US citizen spouse, or you were to give assets to me or Stephen, right? No one, the US likes money from non-US individuals coming into our tax system, right? So I think, you can gift to your non-US citizen spouse, so your US citizen spouse being mindful of Korean rules. But yeah, you may want to be careful. You don't want to be, what I would say to be very cautious with is having the US citizen spouse gift to the non-US citizen spouse, and then they go invest and make money and not have it taxed in the US, and then have it flow back, right? The IRS may be a little bit more suspicious of kind of a circular trade.
Yeah. Fred, I want to just add to your response onto that question, and you pointed out correctly that it really should be a married filing separately tax return.
Yes.
Okay, because the non-US spouse, to the extent that he or she has effectively connected income to the U.S. will have to file a tax return to report possibly the dividends, if there's withholding, or the recognition on cryptocurrency. And I want to pause and not get into too much detail on the cryptocurrency because the laws are changing in real time with respect to reporting and recognition. But the baseline advice would be to file married filing separately, to keep the two spouses' income activity uniquely different and separated.
I think that's a keep the two spouses income uniquely separated. I think that's key. Is you can't be mixing it and such. So we have a question. I have a question. Investments in private equity funds, most of which are structured as Cayman Island entities, are not considered PFIC. Would an investment in a Korean private equity fund be viewed as a PFIC? If so, why the difference in treatment?
So I'm curious as to why the Cayman investments are not considered PFICs. We use Cayman investments, offshore entities, for IRA or non-US investments like charities. But to the extent that our private equity investments are US investments, the Cayman blocker or the Cayman Island Trust is excluded from that portion of the structure. So there's usually a domestic investment and an offshore investment. The offshore is used for IRAs or foundations, non-taxable entities, and the onshore is used for all US persons. The Korean private equity fund should be treated the exact same way. To the extent it has a US nexus, a US investor could invest in the US portion or share of that entity, and then the non-US side would be held for non-US investors, IRAs, and then not-for-profits.
So just for further clarity on that matter, so if a US citizen invests in a hedge fund, it's not a US-based hedge fund, is it taxed as ordinary income on unrealized capital gains?
If it is classified as a PFIC, and it sounds, James, like it would be, then yes, the unrealized appreciation each year would be taxed as ordinary income unreported on, what form is that, Fred, 5420?
So it would be on 8621.
8621.
One comment is that maybe this is kind of also what we're talking about, is maybe the Cayman entity or the Korean fund, they can file the status with the IRS, which is called a qualified electing fund, or a QEF. So this could be it's a very specific election that the fund makes that says, they go to the IRS and say, we're kind of like a US fund, and here's all the things that prove it. Can you please give our investors more advantageous tax treatment? So it's still classified as a PFIC, but they've filed elections to get rid of some of the more strenuous, as Stephen mentioned, the realization that gain each year, the highest tax rates. So there's different ways for funds to set up when they have US investors, but I would be very cautious, because I think a lot of, if you're the only US investor in the fund, are they really going to try to make the whole tax reporting work for you, right? So that's kind of a common issue we see. So some of the Cayman funds are catering to this very well, but if there's two investors in this fund that are US taxable, it's probably not doing this qualified electing fund election.
Hey, I know that we're kind of coming up to the end of our webinar. I know that so many people who are part of this webinar have a lot of questions. I'm sure some of them are a lot more private in nature. But I wanted to thank both of you, Stephen and Fred, for really educating us. I know that even me today, I learned a lot personally. And I hope that I can count on Fred to give me some good advice as well. Again, just for the audience, thank you very much for joining us today. My team will redistribute the webinar so you can have access to the information. And I also provide information on Stephen and Fred's firm for those who who need some additional help, like I know I do. So thank you very much. Thank you for spending I guess an evening for you folks to be here with us. Okay?
It was
you.
our pleasure. Thank you for having us, James.
Yeah.
Yeah, thank you very much, and thank you everyone for attending, and look forward to hearing from many of you in the future, and continuing to be involved with AMCHAM.
Great. Thank you.
Okay. Bye now.
Bye-bye.
Bye.